everyone, and welcome to the James CO channel. Today I am here with Kyle Paxton. Hi, Kyle. How are you?
Hello, always a pleasure. Glad to be here. Let's talk real estate, shall we?
Oh, let's do it. So today's topic is why today's real estate deals aren't performing like they used to and how investors need to adjust their strategy. So I have a lot of good questions for you, and I can't wait to hear what you have to say.
Hopefully I have some answers. Here we
Yeah,
go.
you will. Okay, so the first question is, why are so many real estate deals no longer cash flowing like they did years ago?
Yeah, so in talking to clients and navigating transactions with large shapes and wide variety of shapes and sizes. Help, my words may be escaping me today, Faith. But what we're seeing is that really the income side in the deals we're looking at isn't growing as fast as the expense and the debt service side, and that's been a trend here for the last couple of years, and is still very prevalent in 2026. So existing deals were bought using low rates, assumptions of strong rent growth, cheap and easy refinancing, manageable expenses. And we're basically seeing all of that tighter and less rent growth. A lot of what we do is in kind of that Sun Belt, Florida, Southeast. We have a high volume of clients who have investments in those areas. And, the themes are relatively consistent across all of those markets. A lot of supply, a lot of options that has suppressed rent growth a little bit, and the expenses have just continued to expand.
Wow. So, what's the biggest shift in the market that investors are underestimating?
But my perception on this, and it's not necessarily a super direct answer, I think, but everything just feels a little less forgiving, right? Like your 2020s through 2022, we had a lot of people enter the real estate market, and typically deals are able to float themselves kind of top to bottom, depending on what the asset, regardless of asset, I guess is what I'm saying. And now pretty much everything we're seeing, just like the whole environment is just a little less forgiving. So like, real estate's a little slower, market's not bad, it's just less forgiving. And so, you really have to have tight controls around the underwriting process and understanding, when you're entering a deal with refinance goals or exit deals, like really making sure we're being thorough on what that plan looks like. And is it realistic, and is it built for this tight, less forgiving environment? And so I would say that's pretty much the consistent theme I'm seeing across the board, is just less forgiving. That's what I'll keep gravitating to when I'm having these conversations.
All right. Where are investors overpaying or over, like not understanding the returns right now?
Yeah.
Yeah.
This I'm seeing a lot just kind of based on asset class, right? So I already mentioned like some high supply markets in Sun Belt. So multifamily, we see a lot of that, right? High supply multifamily. James Moore has a strong footprint in a lot of college towns, and a couple of years ago, it's like bam, 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 they're everywhere, right? And so that's a big one. Your older office space, the value add deals with thin margins, and then I'm located in Florida. These deals have high insurance and property taxes often attached to them. So, we're kind of overpaying and overestimating. I'm seeing really just kind of just depend on asset class. And that we talked about the more suppressed rent growth that we're seeing right now. I think in quote unquote old market, which I'm really just talking a couple years ago here, you would still potentially be able to overpay and win because you have the quick rent growth and cap rates were compressed. The recovery is harder in my less forgiving markets currently. So I think it just kind of varies on asset classes, and it gets back just making sure we have the right inputs going into a deal, and make sure we have a good grasp on the current market.
Absolutely. How have interest rates fundamentally changed deal math?
Oh yeah, that's a big topic of conversation, one we deal with all the time, right? So higher rent rates, real estate comes back to cash, right? It's very much a cash basis, cash flow style of business, right? You're typically collecting rents and you turn around and pay your expenses, disperse cash to the investor. So ultimately, this is kind of an easy answer, I would say, but higher rates just reduce cash flow. More of your property's income is going to the lender. It potentially reduces the loan proceeds, that are available to you. So our buyers are having to go find more equity or pay a lower price to hit those same returns. In quote unquote old market, right? I'd say like a deal could support higher leverage and then still produce positive cash flow, and the same NOI in the current market supports much less debt.
Yeah. What is the biggest mistake you're seeing in underwriting deals today?
The easy answer here, I think, is just the stale expense assumptions, and then still kind of falling into that rent growth trap. And then I mentioned this earlier, but this I think is the big one. And a lot of our video content we've put out recently has a pretty heavy, this is a pretty heavy conversation point, but really that optimistic refinance or sale you have when you enter a deal, like relying on that too heavily. A lot of deals currently that I work with are going through the refinancing process, and I keep talking about how everything is just kind of a little more rigid and less forgiving. I mean, the lending process is so much less forgiving, you have to understand that the process takes longer. You're going to get scrutinized more, and squeezed a little bit as you go through these processes. So old market, keep kind of jumping back, old market and now, right? So old market, those aggressive assumptions, I think, were often rewarded because the market kept moving upward, and so you were able to see like, okay, I can make this jump, and I will be able to exit, and it's going to be great. And I guess that kind of offered the optimistic outlook, causes some misses right now, and even like small misses in those kind of inputs I talked about around the insurance, taxes, vacancy, cap rates, can have a significant impact on your cash on cash return.
Absolutely. How should investors be thinking about leverage in this environment?
Yeah. With leverage, the way I'm thinking about leverage is very much more of a risk management decision, and and not just a return enhancer. The classic real estate playbook is you generate some equity, you're heavily leveraged, and you get a great return, rinse and repeat. I think it in today's market is so much more than that, because of the risk. So when you have too much debt, you're taking that good property, a good asset you have, and by itself turning it into a bad investment. We always think about leverage as like amplifying our returns. Debt was cheap, asset values are rising. But now we're seeing, in a lot of ways, leverage is just amplifying the problems that are your foundational problems, right? So I guess to pull this into a little more concise answer here, I think investors should be thinking about leverage so much more cautiously, and as part of that risk stack, more so than the that optimistic kind of return enhancer.
Absolutely. Are there still good deals
Yeah.
right now, or does the
Yeah,
strategy
so no
change?
good deals, Faith. We see them. Um, Strategy does need to change a little bit, right? I'm certainly not, like I said, the market's not bad. It's just different, right? And so what we're seeing is what a good deal is a deal that's kind of grounded in basis discipline. There's strong current cash flow. Maybe the debt's a little more conservative or a little less leveraged than we have been in old markets. And then the operational upside and kind of realistic exit assumptions are what are still driving that good deal. Again, this is varying some by asset class. So that's certainly a big part of that, and location clearly. But there are good deals, and it's different. And so I will say, there are pockets of motivated sellers, broken capital stacks, assumable debts, um, properties that are operating inefficiently, or assets out there where if buyer has that, specific advantage or niche or the additional capital, there's opportunity out there to salvage some of these bad deals we're talking about, right? So oftentimes I think the good deals are salvaging some bad deals. And so there is opportunity out there. It just looks quite different.
Yeah. So our last question is, what separates investors who are surviving versus those who are scaling in this market? Because I think today we talked a lot about, you know, what's changed. So I think a good example of like who's doing it right and how are they doing it right?
I have a lot of good insight into the three buckets of not surviving, surviving, and scaling. Right? There's a little bit of spread of all of them that come in and out of my world here. So, in thinking about this, I think about surviving as like doing the right things and treading water steady, right? So these are the investors who uh, they're protecting their liquidity. They do have cash flow. They manage their expenses a little more aggressively. They kind of get out in front of that. And then what I want to kind of ground this in surviving, because this is such a crux of kind of the not surviving bucket, is just communication between real estate operator, lender, other investors, all kind of the stakeholders in the project. The number one source of broken trust is lack of communication, right? And broken trust can blow up a deal right by itself, right? So the ones that are surviving, I think, are doing all of those things, because if communication breaks down, we're no longer surviving. Now, in getting into the scaling, I touched on this a little bit. Like the scalers are doing all of that strong communication, building trust with investors, if they're growing. So they get that repeat investor and the word of mouth to bring in your friends. And then on top of that, they're looking at where are those distressed, misplaced opportunities where I might have a operating or capital advantage relative to seller. And so those deals are out there. And one more thing I got to harp on, because I talk about it in pretty much every video we do here. The availability of data and the ability to distill data down into an understandable manner. I think I talk to you about this, Faith, every time we talk, but it's like in 2026 here, and this is when we're doing this live. We can get all of our data at our fingertips instantly. And so getting our data organized in a way where we can make meaningful real-time decisions, and we're not looking 2 years in the past like we have in years past with our static reporting and things like that, is huge. The scalers have that down. And they can look at how an individual property is performing, their whole fund, if they, at that scale is performing, and are able to distill that data in a way that they can communicate to everyone involved.
Absolutely. Solid advice. Thank you so much, Kyle, for sharing. And you're going to come back live June 4th. And we're going to kind of build on today's topic too. And it's going to be the great real estate repricing, why old deal models are breaking, and what actually works in today's market. I think, it can be kind of overwhelming with things changing so quickly. And that's why people hire you to help them understand and get all of their data in order. And not be
That's right.
Yeah, absolutely. Well, it was great.
Dramatic title. I'm excited about it. It'll be fun.
Oh,
See you in about a month.
I'm actually excited to talk to you about it. So
yeah.
yeah, well, it was good talking to you, Kyle. See you next time.
Thanks.